The Wall Street Journal put out a very interesting article about the potential stalling of the Chinese economy due to policies surrounding the recent COVID outbreaks in the country. This has led to analysts and the IMF to cut their growth expectations for the country. And now, based on the CCP position that is coming out on these policies, it's looking like this is something that's going to trail into Q3. So is 2022 a lost year? And do I have to revise my Alibaba estimates? That's what we're going to cover in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it. So you can see here, there was a Wall Street Journal article which states that China's economy appears to be stalling, which is threatening to drag down global growth. And in this first part here, you can see that the major reason why the Chinese economy is being slowed down is that it's being throttled by the CCP's zero tolerance approach to COVID-19. And as a result, the Chinese economy is facing a spell of slower growth. Now, you guys know that I've been talking about this since last year, that this was a potential risk for the economy. And every time I did mention it, a lot of people did say in my comments that it's overblown, it'll be over with. Well, now we're looking at a lost year as a result of these policies. So this is another lesson, at least to me, that the low percentile risks sometimes can be the big issue. Now, there's one other item that I've mentioned on this channel, but I haven't really seen any other investors really mention it. And you can see it here, where millions of new graduates are now struggling to find a job with the slowdown of the Chinese economy. And so what that does is, when you have reduced job security in the economy, people generally hoard cash. They stock it away. They don't buy, which turns into a bit of a deflationary cycle for the economy. As more people save because of the uncertainty in the economy, it continues to cause the economy to slow down even more, which prompts even more people to slow down and save. So it's a self-perpetuating cycle that does require intervention. And you can see here, the Purchasing Manager Indexes released by China's government showed contractions in factory and service sector activity for the second straight month in April. This is something that I did mention in the previous video, but I do want to get that across, and I do expect that we're going to continue to see slowdowns in May. And of course, you guys know China is a global growth engine. So if there's a slowdown in the global growth engine, well, you absolutely can be assured that the reverberations will be felt globally. And so you can see here, any sustained slowdown in China will be felt globally, according to the writers of this article, depriving the world economy of one of its most dependable engines when inflation and war are raising recession fears in the US and Europe this year. And you can see here, China was projected to account for a quarter of global economic growth in 5 years through 2026. Well, reality is an interesting thing, because China is still expected to grow slower than they normally do, while the rest of the world contracts. And so, I mean, they're still leading global growth, but not nearly at the rates at which we would have expected. And of course, you can see the reverberating impacts, where commodity exporting countries like Brazil, which count on Chinese demand for products such as iron ore and other metals, could see demand wane. And of course, exporters of components and machinery to China, like Taiwan, South Korea, and Japan, have already started to report weaker sales after lockdowns have shut down Chinese factories. And even Ford came out and said that vehicle sales in China have dropped by 19% in the first quarter from a year earlier. So you're seeing massive slowdowns right across the board, and this does not spell good news for the rest of the year in China. And just previously, I mentioned that there's a lot of new graduates that are not able to find employment, which is causing employment confidence to go down. Well, you can see here that more than 10 million college students are due to graduate this year, which is a record for China, and there aren't nearly enough jobs for all of them. And here's a very scary statistic. About a third of China's 290 million migrant laborers have not returned to their cities of employment since the Lunar New Year in February amid the COVID restrictions. The number of people employed at small and medium-sized businesses has shrunk by around 30%. So here's the problem. You have these factories not producing. You also have these workers not working. And thus, if they're not working, they're likely going to be consuming less. And so once again, deflationary spiral, albeit potentially just temporary, it's still a big impact to the economy. And because of that, in April, the IMF actually reduced their forecast for growth for China this year. You can see here, in April, the IMF cut China's full year growth forecast to 4.4% from 4.8% earlier this year. That's still not bad. However, it's well below the government's target of around 5.5% in 2022. Now, they don't mention it in the article, but the way that the government is expecting to get to that 5.5% is by monetization policies. So you might see major projects or the like announced. However, I don't know how much of an impact that will have on cities that are completely shut down. Ting Lu, chief China economist at Nomura Securities in Hong Kong, stated that if the government doesn't modify its pandemic strategy, there's a chance of another fall in output in the third quarter. And he added that he expects aggressive government action to mitigate that risk. And that's really what I'm trying to say here. You're going to need aggressive government action. But once again, I don't see a world where an exceptional amount of aggressive government policies to spur economic demand will negate shut down cities. You have to move away from these zero COVID policies. Otherwise, you're not going to get out of this, in my opinion. And many economists are saying that China is at risk of a growth recession. So I don't know exactly what they mean by growth recession. I think they just mean slower growth, which I think that's what this is. But here's the bigger part. Chinese officials are pledging to get the economy back on track without, keyword, without abandoning their tough COVID control policies. So this is what I like to call the have your cake and eat it too approach. And here's where we get a glimpse into President Xi's policies for aggressive government action. He's called for an all-out campaign to rev up growth through more infrastructure spending. And there's more plans under consideration, which includes coupons for shoppers to lift consumption and steps to rein in regulatory campaigns against technology and real estate industries that have slowed their growth. Fine, that makes sense, but once again, none of these things really will help, in my opinion, unless you get people out of their lockdown situation. And I'm not the only one that thinks that way. Here are a few economists that believe the same thing. You can see here, many economists are skeptical that traditional stimulus policies will work in any case due to COVID lockdowns. You still have a problem of actually getting shovels in the ground, and if all the shovels are locked in the shed somewhere, it's not going to happen. And so what does this mean for Alibaba really? Well, it really comes down to how should I be thinking about my 5-year growth estimates. So you can see here, this is actually my model for Alibaba that you guys all have access to. With never-ending zero COVID policies in China, is the base case for the core commerce business still expected to grow revenue at an 18.9% clip? You can see that in 2017 it grew 45%, in 2018 it grew 60%, 2019 50%, 2020 35%, and 2021 it grew 42.4%. When I originally forecasted 18.9%, I said that some of these COVID issues will reverberate through the economy, but the other thing is there'd be more competitiveness and just the fact that growth acts like an anchor. I actually cut Alibaba's revenue growth rate in half of what I thought it historically was going to be because I didn't believe that the company would be able to grow as fast into the future. However, even that 50% haircut to revenue growth now seems like it's a little bit aggressive relative to the policies that the government is spouting. So I don't know how to think about this. One thing's for sure, I'm going to revise that model to show year over year growth, and all the Patreons are going to get access to that because I'm going to really ratchet down 2022 and 2023 and then keep 2024 and beyond so more closer to that like 18 or 19% range, maybe like 10 to 15. But what is this really going to do? It's going to bring down my valuation of Alibaba, and that's a scary thing. However, based on the current share price of $85 per share, that's kind of where I think it landed today. I don't see the company not being undervalued. That being said, is it still going to be worth $300 per share? We'll see. I'm going to revise that model once they release full year's earnings and provide their outlook into the future. And so you can see here that with a multiple of 20 times earnings, right now, I have the company valued at $300 per share. But like I said, that could come down. Now, the business is only valued at $200 per share. So even if it comes down to $150 per share, just based on the cash that they have and the equity securities and just the cash accretion, which will reverberate through that new model anyways, you might just end up at a valuation of $250 per share for a company that's currently trading at $85 a share. So not a big surprise there, but it's just something to think about as we move towards the end of this year. And what we thought were temporary policies now become more medium-term type policies. And of course, the last thing that I do want to point out to you guys is when I analyze companies, the Patreons know this, I highlight qualitative areas as well as quantitative areas. I don't think it's just enough to just show what the price is relative to its intrinsic value. Over here, you can see it's 33%, but there's other risks. Does the company have debt? Are they inflationary resistant? How large is their economic moat? And with Alibaba's situation, they've even told us that they're experiencing more and more competition in the internet space. And so I would say Alibaba's economic moat is probably a medium, which presents a risk into the future, as it has already impacted results. So that's something else to take into consideration when investing in a company like Alibaba. And like I always say, you guys can get access to all the models. We have tons of models on many different types of companies, and you can get access to all of that at just $5 per month. And once again, I always say, if you subscribe to the Patreon, you look at the data, you look at all the analysis, and you say that it's not for you, no problem. I'll refund 100% of your 1-month subscription. So there's zero risk to you. And I really encourage you to join us. There's a lot of good materials there. And one of the biggest things that I love about Alibaba is that they're continuing to invest in the grocery space. Another grocer that I really like is a grocer in North America by the name of Sprouts Farmers Markets. And if you guys are interested in learning more about Sprouts Farmers Markets, you're in luck because I just released a video on that company, which you can get to right here.